I'm Emily Chang in San Francisco, and this is Bloomberg Technology. Coming up in the next hour, Google parent Alphabet beating estimates, and we talk to Alphabet CFO Ruth Porat. Her thoughts on corporate taxes, cookies, and the cloud business, plus a big new share buyback. And AMD and Texas Instruments out with their results as well. We'll find out how the global semiconductor shortage is impacting chip makers' business and forecast. We'll break down all the numbers you need to know. And a Senate panel looks at how algorithms amplify dangerous content and shape user behavior on social platforms. Facebook, Twitter, and Google's YouTube, all in the hot seat. Those stories in a moment, but first, investors more or less held their breath today, especially ahead of the tech heavyweight Alphabet reporting its results after the bell. With all the market day action, let's get to Bloomberg's Katie Greifeld and Kriti Gupta. Katie, you're up first.
Emily, it was a tough day for stocks. The S&P 500 ended a touch lower after treading water all day. Tech lagged, though, as we awaited Alphabet and Microsoft, with the Nasdaq 100 closing 0.5% down. Chips brought up the rear, though, with the Philly Semiconductor Index falling 0.8%. Now, part of the reason we're seeing tech lag is because the bar for this round of earnings is so high. Tech EPS revisions have been rocketing higher since June, much more so than the communications sector and the broader S&P 500. Now, those high expectations mean that even though most tech companies have been beating estimates, they aren't being rewarded in the stock market. In fact, the biggest winners so far this season are the small cap stocks. Russell 2000 companies have gained 0.9% on average the day after earnings. The smallest companies, your microcaps, they've surged 1.6% on average the next day. And Kriti, it's those small companies that are expected to benefit the most from the economy reopening, more so than your big tech names. And we're absolutely seeing that play out in earnings reactions so far.
Well, Katie, super interesting stuff. From small caps, let's go over to semiconductors. You mentioned they were lagging today. Of course, the stocks index down 0.8% on the day. But take a look at this board behind me. These were the 4 stocks that were actually higher on the day. Of course, not enough to bring the whole benchmark higher, but this is really important to look at because, look, Advanced Micro Devices just reported earnings, a very bullish outlook, a massive forecast for 2021. You can see the outperformance up 3.3% in after-hours trading, not really translating to those other names. Let's see if they will in tomorrow's trading session. Flip up the boards. Let me bring you to the next earnings story today, and that is, of course, Microsoft down 3.6%, even though we did actually have not just a beat on the surface, but also some of those kind of massive cloud computing, double-digit revenue growth. And yet, once again, no change to the other kind of companies that deal with cloud computing. So this is really an important theme that you're seeing. Some of those earnings stories are isolated. And one more time, I want to bring you to the other earnings story we're talking about right now, and that is, of course, Alphabet earnings coming out hot. Another EPS beat. You can see that 4.7%. And a massive $50 billion share buyback. That is translating a little bit into Facebook, not so much into Twitter. Let's see, though, how much of this is a buyback story and how much of this is a broader tech story, Emily.
Absolutely. Kriti, Katie, thank you both. Going to talk a little bit more about Alphabet now, diving deeper into the results with Daniel Newman of Futurum Research. Dan, I just got off the phone with Ruth Porat, who of course talked about how this is a broad-based recovery, but in talking about, what changes in behavior will actually last, is this the beginning of something big? She said, we think it's too early to forecast the extent to which changes in consumer behavior and ad spend will endure. The pace of recovery is very different around the world. What's your take on what we're seeing in these results?
Yeah, the results are really strong, Emily, and I think that was a very conservative response. The numbers really blew out what was expected, and there was a significant, I think it was about $11 billion beat on the ad business. We're starting to see recoveries across multiple sectors. We're starting to see companies raising spend in advertising, and that's what's bringing it back. It's not just the industries that have been strong historically through the pandemic, but we're starting to see things like travel and hospitality come back. I think if you've been out a little bit, I traveled this past weekend, and you're seeing busier hotels. You can't get a rental car. There's a lot of momentum going on, and that, of course, is going to fuel spend for growth. So I think as a whole on the ad business, it's a little conservative outlook, but I think it's, the company, Google doesn't really, or Alphabet doesn't really do guidance. And so I think that's probably the safest response, especially in case this momentum doesn't continue or there's any setbacks due to the pandemic. But overall, the ad business was really strong. And the cloud business was another area that I think everybody's eyes were on, Emily. We saw last quarter, first time reporting the details of it. This quarter, it broke just over $4 billion in revenue. But what I was really looking for there was the narrowing of the losses. Just a year ago, it had seen about 1.7 billion in losses. This quarter, it actually dropped those losses to just below $1 billion. So while Thomas Kurian and the team there are aggressively sort of buying and acquiring business at a loss at this point, making investments, expanding data center, hiring, we are seeing those narrow, and that should give some encouragement that within the next few quarters, Google Cloud could see a profit as well.
Well, then in terms of when the cloud gets to profitability, if that will be a priority in the near future, she said they're going to continue to invest. That cloud is going to be one area where they continue to see a big market opportunity. They're still going to be doubling down there. And also in headcount as well as real estate. Even though we've been in this hybrid mode, remote work mode for a year, they're starting to call employees back to the office. They're building out new buildings across the United States and around the world. Do those investments concern you?
No, I think Google, they're looking at AWS, they're looking at Azure. Obviously, we saw their 50% growth today. That's the competition Google sees. They want to be numerically in that same ballpark, 8, 10, $12 billion a quarter. So I believe with the bottom line results, we saw the blowout on EPS for Google. They see this as very strategic. They see a long-term path to growth, and that if it takes a little bit longer to get to profitability, that investors should stick by the company, as it's not looking to grow incrementally or in small volume. The team there is looking for its results to be on par with those bigger cloud players. And if it takes some more quarters to get there, more investment, more hiring, more real estate, I think that's the path. I think number 3 isn't the objective of Google or Alphabet in any category in which it competes.
Now, I want to talk to you about Ruth Porat's response to Biden's corporate tax plan, because it affects not just Alphabet, but Microsoft. Of course, the president looking to increase the corporate tax rate from 21% to 28%. She had a very diplomatic response. She said there are clearly urgent funding needs around the world, including U.S. infrastructure. We understand, though, that tax policy is just part of the answer. We urge governments to look at raising revenue in a coordinated way and think there's more momentum to reaching a multilateral solution on tax, which we think would be more valuable and more durable. So basically, she's saying don't just tax us, though we understand that's part of the equation. Are you concerned about Biden's tax plan as it pertains to, not just Alphabet, but Microsoft and other big tech companies?
I think everyone is concerned, Emily. If you look at the reaction last week when some of those new tax plans came out from Biden, you saw the higher capital gains rate, you heard about the higher corporate tax rate. Companies are concerned, and there's always this teeter-totter between will dollars be, will we stall investment, whether it's the infrastructure or hiring dollars that you mentioned, expanding data centers. Will companies start to pull back a little bit if they do not believe there's as much profitability at their disposal for those investments? And so this really does become that sort of economic teeter-totter between trickle down and trickle up economics. Will the government most intelligently put those dollars to use with higher tax rates? And will companies, especially big ones with resources like Google, Amazon, Microsoft, with endless resources, tax accountants, find ways to work around to not, to avoid paying the highest tax rates, because they're going to make the right investments, and everybody knows that. So a lot of people are also worried about how this fits down the ecosystem, the partners of Google and Microsoft and Amazon, all those mid-market integrators, VARs, cloud companies, software providers that use their clouds. So this is a big discussion, and just raising taxes for revenue isn't going to solve the problem in itself, but it definitely has to be on the table as one potential solution.
So talking about Microsoft, also a beat on earnings and on revenue, huge growth in the cloud, 50% growth. Question, do you think that momentum holds up when we are through reopening? At the end of this year and into next year, can they keep up that kind of momentum?
Yeah, this was the biggest quarter growth, I believe, since 2018 has been the headlines here, about 19% year over year. Satya Nadella has been pretty outspoken that he sees this momentum carrying through. I have to say, my consensus is that I agree. The company's very focused on vertical. It's been able to see some very significant growth through the digital transformation that's gone on during the pandemic, which accelerated growth in areas like Teams, in areas like PC, which saw huge numbers, but also we saw Azure. A lot of people thought 2 or 3 quarters ago when the growth fell below 50%, that it may start to decrease further and further down into 40 or 30%, Emily. A lot like where AWS is now that it's over 12 billion, but it hasn't. It's actually bounced back with 2 continuous quarters over 50%. But you're seeing growth. I believe the Dynamics 365, which is their competitive product with Salesforce, saw 45% growth this quarter. So companies are spending on CRM and ERP type software. You saw PC sales up 19%, tracking along with Intel's results last quarter that saw extremely good numbers. And then AMD, which reported today, which had blowout year-over-year results. So I think that tech intensity that Satya Nadella talks a lot about is really in place. And now you're seeing the company really focus, Emily, on what I see as vertical. So the Nuance acquisition, for instance, getting into healthcare, seeing it double its TAM, playing off of its whole cloud ecosystem, because it's not just Azure, it's Office, it's Teams, it's a stack, and it's getting really sticky, which is a big reason why we're seeing that cloud growth stay so high for so long.
All right, well, we're going to talk to Microsoft President Brad Smith about that and more tomorrow. We'll be interviewing him exclusively here on Bloomberg Technology. We'll be listening into the Microsoft call, as well as Alphabet. Dan Newman, Futurum Research Principal Analyst. Always good to have your commentary here on the show. Again, Brad Smith of Microsoft joining us tomorrow. All right, coming up, AMD and Texas Instruments also reporting results, more on how the global chip shortage and rocketing demand is impacting their outlooks. We'll break down the numbers next. This is Bloomberg.
Q1 had some of the most difficult supply chain challenges that we've ever experienced in the life of Tesla. Insane difficulties with supply chains, with parts over the whole range of parts. Obviously, people have heard about the chip shortage. This is a huge problem.
Tesla CEO Elon Musk there after the company reported its results, highlighting just how severe the chip shortage has been globally. Meantime, chip makers Texas Instruments and AMD out with their results after the bell. For more on how they did, let's get straight to our Ed Ludlow in San Francisco. And of course, Ed, chip shortage top of mind. What would you highlight here?
Yeah, the thing about Texas Instruments is that they manufacture 80% of the chips that they offer to customers themselves. They don't outsource to a third party. And they were talking about that key word that we've learned about since the start of the year, lead times. In other words, the time it takes from a customer ordering chips to the time it takes for the company to deliver them. They said that in the first quarter, they still had hotspots in different industries where lead times got extended. But the good news is those lead times are now steady, and that they're able to actually offer a number of off-the-shelf chips. In other words, they have inventory. So that will be a really interesting sign to people watching the global economy. Really, Texas Instruments is a bellwether because some of its customers are very heavy industrial companies. They're automotive companies. They service such a broad range of industry in a number of jurisdictions that demand for their chips, the old-fashioned industrial types, are really what gives us a sign of how the economy is firing going forward. On the AMD side, there was less commentary on that, although they gave such a bullish forecast for the year that it seems like demand is still very strong.
So talk about the chip shortage in particular. We just heard Elon Musk there talking about how this is impacting Tesla. I mean, this is impacting so many different businesses around the world, impacting consumers and you know what we have access to as we're going through this major transformation and transition back to work, back to school. I mean, any additional outlook or insight or fresh commentary on when this will let up?
So this is where you start to read the tea leaves, because Texas Instruments gave a forecast for the year that was bang in line with analyst estimates. They didn't raise their guidance in terms of the sales that they expect to make. They didn't give any specific bullish outlook on particular customers. the thinking from Wall Street on that is that the demand that we thought was there, particularly from the automotive industry that had to cut production of cars because of a shortage of chips, it just actually isn't as extreme as we thought. There's exactly the same thinking that you've just outlined, that actually we're now starting to return to work, we're starting to return to school. So that extreme growth in demand for laptops, for tablets, for smartphones, well, if they're not raising their forecast for chips that provide for those things, then maybe the demand's not as bad as we thought, and the supply equation will level out in due course.
So let's talk about AMD then in particular, which is not reliant on TSMC to manufacture its chips. How did the AMD story play out?
So the AMD story is opposite to Texas Instruments. They gave a very bullish outlook for the rest of the year. 3 months ago, they said that sales would rise by 37% in fiscal 21. They upgraded that to 50% in fiscal 21. And the feeling here is that the demand for what they're offering is really strong. But there's a subplot. I love a subplot. Remember when Intel had earnings a few days ago or a few weeks ago? They saw their shares fall, and the concern was that AMD was stealing market share from Intel because Intel said that its data center business was weak, and yet you have AMD here today saying, oh, our data center business is pretty strong. The CEO of AMD has really transformed the company's offering in recent years. It's made the product more cutting edge. They do some business with Taiwan Semiconductor, so they are reliant on some of the third-party manufacturing, but again, it's a case of reading the tea leaves because there's no explicit commentary yet from executives. It seems like AMD is doing well, A, because of broad-based demand, and B, because they may be stealing market share from Intel, which is not good news for Pat Gelsinger.
AMD, I should say, is reliant on TSMC to manufacture its chips. Lisa Su, the CEO there, making big moves. Ed Ludlow, thank you so much for that update. We'll be following those results over the course of the hour as well. Coming up, EV battery maker QuantumScape recently called a scam by activist firm Scorpio Capital. QuantumScape's CEO hitting back at critics. We'll interview the CEO, Jagdeep Singh, next. And speaking of EVs, as we had to break, Tesla shares down a day after the company reported a record profit. Investors shrugging, a sign perhaps at the lofty expectations Tesla now contends with after an 8-fold gain in the stock last year. Among the critique from analysts, Tesla didn't offer specific estimates for vehicle deliveries in 2021. We'll keep following. This is Bloomberg. A new report says Amazon will surpass Walmart in U.S. retail sales in 2025. The report from the firm Edge by Essentials suggests the world's biggest online retailer has just too much momentum that Walmart can't stop, despite big investments in its own e-commerce. Edge by Essentials CEO Darren Baker saying the pandemic has permanently changed consumer habits from in-store to e-commerce. And coming up, executives
from computing power had been growing at an exponential rate, and memory storage and disk storage all have been growing very rapidly. But batteries and energy storage had been growing at a very, very slow rate, about 3, 4, 5% per year. So it takes about 20 years to double energy density in batteries at that rate. And I got obsessed enough to where I decided to leave my job as CEO of this company, join a venture capital firm as an entrepreneur in residence to work on this problem.
Apart from becoming the hottest battery startup and being public, you've also now got the infamy of becoming the first battery startup that's been attacked by a short seller. Now, short sellers are plenty in the world. They come along, but they're able to put out these sort of 100-plus page reports because of the secrecy in the industry, and because the third-party validation, which is not shown or results are not shared, give them fodder to be able to poke holes. And many of the issues that were raised are issues that we've talked about. Batteries are hard. You have to be able to scale them up. That those numbers have to match what the performance needs to match. But how do you tackle the sorts of attacks that come from places like Scorpion Capital?
If getting a third-party lab to test ourselves would get rid of these kinds of random attacks, it'd be something that we consider. Do you really think, Akshat, that if all the data we had shared had in fact been generated by a third-party lab, that anything would have been different about that particular report? Because that report was not interested in the facts, right? I mean, let's be honest here. I mean, first of all, I want to be candid, right? There is a legitimate short thesis you could have about QuantumScape, right? And that short thesis would be around, well, this is great. It demonstrated some amazing results in terms of the capability of these cells, but they still have yet to scale up the production and the factories and the time that it takes, all that. And those are uncertainties. And so somebody could say, you know what, I believe that's going to be harder than they think. Legitimate point. We don't argue with that because they're entitled to that opinion. The problem is that's not what the short seller was doing. He shorted the stock most likely on a Wednesday. On a Thursday morning before the market opened, he published a report full of lies, misinformation, and innuendo. Later that day, as the stock price dropped, he probably covered his short already. So he was already gone from the market. This had nothing to do with a belief that the company's fundamental risks were fundamental. This is about essentially market manipulation. And that's what I have a problem with. So I'm not sure that a third-party lab, having tested these results, even if all the data in our presentation came from a third-party lab, would have changed that particular scenario. But I'll be honest with you, we don't intend to have our strategy be driven by a random short seller looking to profit on the markets. However, the questions you're bringing up for people like you who are legitimate observers of the industry, if it makes you feel more confident in the data, then it's something that I think we will in fact consider.
What do you imagine the future of lithium-ion batteries? Not 2025, when you might be able to get into a car, but 2030 and 2035 and 2040.
Well, maybe a couple quick points here. One is that because battery chemistries are so long-term in nature, they don't change very rapidly. Again, as we discussed at the beginning, lithium-ion in its current form has been around for about 30 years with relatively incremental changes over that period of time. It's not impossible that lithium metal with solid state could drive another few decades worth of battery technology with relatively small improvements to what we're doing today. So we think what we're doing is so fundamental that it could easily be the basis for the next 20 years of battery improvements or beyond.
QuantumScape CEO there, Jagdeep Singh. You can catch that full interview at Bloomberg.com. Meantime, I want to get to some breaking news about President Biden's economic plan. The president will be omitting an expansion of the estate tax from that plan. Biden had pledged during the campaign to raise estate taxes, but looks like an estate tax hike will not be part of this economic plan. His aide's not sure if Democratic lawmakers and lawmakers in general would have backed an estate tax hike. So, of course, we'll continue to follow that as his economic plan rounds out. Coming up, execs from Facebook, Twitter, and YouTube facing probing questions from the Senate about their algorithms, which one senator says are, quote, driving us into poisonous echo chambers. We'll have all the details next. Welcome back to Bloomberg Technology. I'm Emily Chang in San Francisco. U.S. lawmakers pressed policy execs from Facebook, Twitter, and YouTube in an hours-long hearing about how user content is shared and highlighted on their platforms through algorithms. The hearing coming as Congress takes a broader look at how to overhaul Section 230, which protects internet companies from liability for user content. For more, I want to bring in Bloomberg's Anna Edgerton, who covered the hearing for us. So talk to us about the line of offense here with both Democrats and Republicans, the arguments that they took.
Yeah, and it was interesting. You could hear some very genuine concern from these lawmakers about how social media companies really kind of direct the level of public discourse in this country. You know, so much of our kind of social interaction and, you know, exchanges with our fellow citizens happens online, and these companies have a lot of control over those exchanges with not very much oversight. So the questions that we heard from both Democrats and Republicans were, you know, how do you make decisions, you know, baked into the algorithms to determine what each user sees? And, you know, that's different for each person. So there's concern for the lack of transparency and really a desire to understand what's at the base of these decisions in case there needs to be policy to more heavily regulate how that happens.
Now, the metaphors about how companies use algorithms are so evocative that it's hard not to mention them. Tristan Harris, who's been a frequent guest on our show, of course, the star of Netflix's hit documentary, The Social Dilemma, has talked about how these companies use algorithms. Take a listen to the metaphor he uses.
It's almost like having the heads of Exxon, BP, and Shell asking about what are you doing to responsibly stop climate change? Again, their business model is to create a society that is addicted, outraged, polarized, performative, and disinformed. That's just the fundamentals of how it works.
Did that idea, Anna, come through in the hearing? And then how did the tech execs defend it?
Yeah, and that was something that we heard not just from Tristan, but also from the senators and from some of the other commentary, was that this is the business model. The business model is engagement, and unfortunately, what drives engagement is often the misinformation or disinformation or the most inflammatory content. Now, the executives that were testifying today kind of push back on the notion that there are toxic places to go on their platforms, and part of the reason they made this defense was that the companies use algorithms to remove harmful content before it ever gets to users. They say, a fraction of 1% of content is flagged as violating the company's policies. However, it's not evenly distributed. So when you have someone who's kind of deep into these echo chambers that Republican Senator Ben Sasse mentioned, who's kind of, very much drawn into these kind of worlds within the social media platforms, they get a more intense experience because of the algorithm. So it's not just what the general population sees, but also how information is distributed, and in some cases unevenly distributed on these platforms.
So let's take a listen to the response of these companies. A statement from Facebook. The reality is it's not in our interest financially or reputationally to push users towards increasingly extreme content. If we prioritize trying to keep a person online for a few extra minutes but made them unhappy or angry and less likely to return, that would be self-defeating. Twitter is saying that policymakers should consider the ways tech, algorithms, and machine learning make Twitter a safer place and enhance the global experience for the internet at large. YouTube saying some speculate that we hesitate to address problematic content because it benefits our business. That's simply false. Failure to consistently take sufficient action to address harmful content not only threatens the safety of our users and creators, but also the safety of our advertisers. And of course, our business depends on trust. Is this hearing likely to result in any substantive changes?
Well, that's part of the problem, is that it's a really hard thing to legislate. Not only is it a tricky technical problem, how do these companies effectively moderate content in different cultures, different languages, even, within the context of the United States? They haven't figured out how to completely do that. And, they will readily admit that they miss some of the content that should be removed. And then the other question is, can legislation keep up? The legislative process by design is pretty slow and deliberate, even more so not by design when we have such partisan gridlock in Washington. So, the ability of lawmakers to kind of accurately address the problem and, create policy to fix it is really, really hard for them to do.
All right, Anna Edgerton following that hearing for us. Thanks so much, Anna, for your takeaways. Meantime, Lyft is selling its self-driving unit to Toyota subsidiary Woven Planet for $550 million. It joins Uber in stepping back from the costly autonomous car research, once thought to be on the verge of revolutionizing ride-hailing. Our Ed Ludlow caught up with Lyft co-founder and president John Zimmer to hear what pushed him to make the deal.
We've had an autonomous platform, which is actually the deployment of autonomous vehicles being built for quite some time. We're actually the leader in commercializing autonomous vehicles. We've done over 100,000 paid AV rides. And this is doubling down on that part of our strategy so that we are focused on the piece that we do. The level 5 work, which was the name of our program that we've been doing, has been successful. Obviously, Toyota saw that opportunity. And this allows us to work with multiple partners to bring the best and safest technology to the platform for our customers, and to focus on the customer experience and the marketplace technology along with the fleet management that is critical to the success of autonomous vehicles.
I guess, what was the biggest impetus for Lyft? Was it cash flow concerns on the core business? Was it the technology itself and what it would take to bring it to market? What pushed you to do the deal?
It was the long-term strategy and how the world or the industry of AVs has changed over the last 4 or 5 years since we got started building out that program. So when we started, it wasn't clear that there would be multiple well-funded autonomous vehicle providers. And today, there are several well-funded autonomous vehicle providers, and we brought a new approach to market. Our team had done data-driven autonomy that was basically building an autonomous system based off fleet information so you could use real scenarios to make the system better and better. So now that differentiated approach is in the market, and when the transaction closes, will be with Toyota. So we've now brought another well-funded player with a new approach to market. And there's only 2 major networks in North America for transportation. And we believe we're in the best position, given that we're the only ones doing fleet management, which is absolutely essential in an autonomous vehicle future. And we have what we believe is the best marketplace technology.
Then talk us through the timeline from Lyft's perspective. When will we see Lyft rides in the real world that are fully autonomous, and what gets you there?
Yeah, so as mentioned, we have done over 100,000 autonomous vehicle rides. Those do have a safety driver in them. So if your question is when that safety driver will be removed, that will likely be over the next 2 or 3 years. We've announced a partnership to bring them to market in multiple cities in 2023, and that will continue to scale from there.
Does this move impact any potential for Lyft to diversify its business? Do you think that you will move into the delivery of foods or goods or any other forms of autonomous transport in the future?
So we've already talked about one thing that we're doing is now B2B or business focused delivery, so that we can be a platform for retailers to have a national and into Canada infrastructure for deliveries without needing to rely on a consumer marketplace. But we are extremely focused on what we do and what we do well. It's allowed us to increase our market share, improve our service to drivers and riders over the last several years. And that focus is on consumer transportation, which is, in our opinion, a multi-trillion-dollar opportunity and one that requires deep focus.
Lyft co-founder and president John Zimmer there with our own Ed Ludlow. All right, coming up, the first crypto awards credit card with more than 140,000 people already on the wait list. We're going to speak to the chief operating officer at Gemini about its new partnership with MasterCard to bring crypto mainstream. That is next. This is Bloomberg. Bitcoin extending its bounce back from recent lows, climbing back past 55,000. And in the latest sign that Wall Street is warming up to the largest digital currency, JP Morgan is preparing to offer a Bitcoin fund to its wealthy clients. This is MasterCard and cryptocurrency platform Gemini announced a partnership to launch the first of its kind crypto rewards credit card this summer. More than 140,000 people are already on the wait list. Joining us now to discuss, Noah Perlman, Chief Operating Officer at Gemini. Noah, thanks so much for joining us. How exactly does this work?
This is an absolutely fantastic product. So the way it works, we partnered with MasterCard. We'll be issuing this Gemini credit card a bit later this year. And what's great about it is that users are able to earn crypto on every swipe that they make. Every charge they make, they are able to earn crypto as a reward. So think instead of frequent flyer miles or hotel points, they're earning crypto.
So you pay in traditional credit, traditional money, but you earn crypto in return. Is that right?
Exactly. And what's great about it is it allows people who may be crypto curious, they've heard about the space, or maybe they're interested in the space, but they haven't yet invested. For those users, this is a great sort of way to passively get exposure to the space without changing their behavior. They continue to sort of use the card where they would automatically use it, and they're going to start owning Bitcoin or the other cryptos that have on the platform.
Right. You can choose from any of 30 different cryptocurrencies available on Gemini. Talk to us about the interest. 140,000 people. I mean, what are you hearing from consumers and interested parties about what's attracting them to this?
Yeah, absolutely. So when we announced it earlier this year, we opened the wait list and we had, as you said, 140,000 people on the wait list to date. Although my team tells me that since we announced our partnership with MasterCard today, we've had incredible interest just today. What's particularly exciting about the numbers that we're seeing is that more than half of the people on the wait list are not existing Gemini customers, which means they're new to the space, which is really what Gemini is all about. It's attracting more and more users to crypto and presenting sort of a safe, reliable way for people who are interested in the space to come in.
So does that mean there's more than 140,000 people on the wait list now? How many can you tell us?
Today's announcement has been just incredible. So I actually don't have the exact amount, the exact numbers in real time, but it's north of 150,000 as we speak.
Okay, so do you worry at all that you're encouraging consumers to take on more risky assets by offering this option? You don't have any control over which way these 30 cryptocurrencies go, up or down. Does that matter?
No, it's a good question. And the answer is that we think that this is a really compelling product. I mean, when you think about other types of rewards, you think about airline rewards or frequent hotel points, those rewards also are sort of subject to dilution, subject to sort of change in programs. So yes, there's always the chance that there's sort of volatility. But as a reminder, I mean, Bitcoin is the best performing asset class of the last 10 years. And so we remain bullish that this is a great, compelling product for users. And one thing I should add here is that what's exciting about the product that we're offering is that it delivers crypto rewards in real time, as opposed to waiting till the end of the month. And given sort of the price action in the sort of the underlying asset, this allows cardholders to have full control over their rewards from the minute, literally the time that they make the purchase. Those rewards are going to their account.
Now, we've been watching a number of different crypto companies now hit or explore the public markets. We just saw Coinbase do a direct listing. What are Gemini's plans to go public, and at what valuation?
Yeah, look, it's super exciting time in the space. Obviously, we, like others in the industry, watched Coinbase, real validation for crypto. What I'll say on our plans are what our founders have said previously, which is that we're keeping all options open. If it makes sense for us to test the public markets, we will do that. But right now, other than just maintaining all optionality, that's sort of the extent of what we're prepared to say, what I'm prepared to say right now.
All right. Well, I had to try, Noah, but we'll keep watching. North of 150,000. Thanks for sharing that with us. More than 150,000 people interested in this new rewards card. Noah Perlman, Chief Operating Officer at Gemini. Thanks for joining us. All right, coming up, going all in on content creation. Instagram, the latest to jump on the content creation tool generator and marketplace. This as Mighty Networks is building what it considers to be an operating system for the creator market. I'm going to speak to founder and CEO Gina Bianchini next. This is Bloomberg. Last week, we brought you a special series on TikTok, and in part of our conversations, we introduced you to young and up-and-coming content creators like Katie Feeney and Josh Richards, who make millions on content and brand management. Content creation, a lucrative business in building the networks and platforms to support the so-called content economy is the aim of Mighty Networks. Mighty Networks is building what it considers to be an operating system for the creator market, and just raised $50 million in new funding. Joining us now, founder and CEO Gina Bianchini. Gina, great to have you back here on the show. So you've got creators, brands, and coaches Yeah. Of course, you've got creators, brands, coaches on your network every day. We just did these interviews with Katie Feeney and Josh Richards, who are huge on TikTok. Talk to us about what you're offering creators like that.
Yeah, so we're actually offering a little bit of a different approach to the creator economy. So when we look at the fact that there are these small number of content creators who are making millions on TikTok, we also look at it and we say, well, wait a second, how could we use the same energy around generating new payments, new digital subscriptions? How could we generate that for more people? And actually the answer isn't content. It's not fighting for attention on platforms like TikTok or Instagram. It's not about building a massive following and hoping for sponsorship. It's actually building really strong communities that you can set up and have as your home on the internet. So if anything, Mighty Networks exists to be the easiest platform anywhere for more and more people to be able to become creators. And that is why we are here. That is why we exist. It is about ending this constant stream of content that you're building for other people's platforms and actually taking the whole ethos of creation and expanding that to really serve more people with communities that anybody can build and anybody can participate in the creator economy.
So speaking about communities, Lovey Ajayi Jones is one of the many creators on Mighty. You know, we also explored some of the disparities in content creation, especially when it comes to Black and white creators, where when it comes to a sponsorship deal, a white male creator might get $10,000, a white female might be offered $5,000, a Black male might be offered $1,000. How are you helping to democratize these kinds of opportunities?
I'm really glad you asked that. So at the end of the day, creators need to own their own assets. They need to own their own community, and they need to be able to offer their community, whether it's memberships, whether it is access to events, whether it is online courses that they run live or they record them and have a community that is mastering something interesting or important together. And one of the reasons that we have seen 200% growth in the creators using a Mighty Network today to build out their community, and a significant percentage of them being creators of color, is because you own your Mighty Network. It is not about renting attention from large platforms, trying to build, massive followings and then maybe getting paid pennies on the dollar if you get paid at all. It's instead a much better model for both traditional and non-traditional creators to own their own community, to be able to offer their members something of value, typically not just their own content, but content, community, and the connections that any of their members are making with each other. And so that's really the power of a Mighty Network.
You've been raising money in Silicon Valley for a long time, Gina, as a female entrepreneur. We just got a new report from Allraise that shows what many suspected for a while, that women are backsliding in the pandemic. Funding raised by all-female teams is dropping, seed funding, angel funding, late-stage funding. What was your experience like raising money over the last year, and how concerned are you about this?
Well, so I will answer this. So first of all, for us, it was, I would describe it as finally easy. And that has everything to do with the fact that, we just have numbers you can't ignore. And, there's the Steve Martin quote of like, you have to be so good they can't ignore you. We finally got to a point where we were so good they couldn't ignore us. But that wasn't always the case. And the reality is that fundraising, when you aren't out of you're not straight out of central casting as something investors expect, it makes fundraising hard. And it's one of many reasons we're so passionate about what we're building with Mighty Networks, because you can bootstrap a business for, less than $1,000 a year and with fewer than 30 members. That's really the innovation that we've unlocked in the last year. Is our software gives people the opportunity to become creators, not from millions of followers that, again, you might get paid a sponsorship, you might not, but rather this ability to bring 30 people together around a topic that they care about and generate digital subscriptions or digital payments that way. If anything, my experience with fundraising in Silicon Valley has made me even more passionate about providing opportunity, especially for non-traditional founders, to be able to bootstrap their own business and control their own destiny.
All right. Well, you have pounded the pavement for so many years and paved the way for many young women entrepreneurs to follow. Gina Bianchini, founder and CEO of Mighty Networks, thanks so much for sharing that with us. And that does it for this edition of Bloomberg Technology. Reminder, tomorrow I'll be speaking exclusively with Microsoft President Brad Smith. Do not miss it. And we'll be recapping all of the big tech results out today. I'm Emily Chang in San Francisco. This is Bloomberg.